expectation for the future volatility of a security is different from what the market is implying in the price of options, how can you take advantage of this perceived mispricing? First, let's take a look at what the largest impacts are to a typical options position. To do this, I will calculate the dollar value of a typical move in each of the factors that go into the Black-Scholes-Merton option pricing model. I'll use the standard option attributes as outlined in Chapter 4, and for this example, I will use a call option. Now let's calculate the delta of this option. But what we would really like to see is what is our P&L for a typical change in the price of the underlying. Since delta already represents the change in value of an option for a $1 change in the price of the underlying, we just have to multiply delta by what we would consider a typical move. As we saw in Chapter 4, the rule of 16 means that we can divide an annual volatility by 16 to get an approximation of a typical daily move in the underlying. Since our option is priced using a 32% implied volatility, then the market is pricing in a typical daily move of about 2%. So to get the P&L of our option due to a typical daily change in the underlying, we can multiply delta by 2% of the price at each price point. So a typical daily move in the underlying would cause our option to change by a pretty significant amount, as long as the option is not deep out of the money. We can repeat the same process for other option Greeks too. Let's look at the theta of our call option next. Theta represents the time decay per day, which is already a typical move in that input, so we can keep this one as is. But note how much smaller the impact of time decay is versus delta. Until the option is close to expiration and at the money, time decay is typically pennies, whereas P&L attributable to delta is often orders of magnitude larger as long as the option is not deep out of the money. Now let's take a look at Vega. A typical move in volatility will be very security dependent and will even change over time. As a very rough estimate, we could say that for an asset with an implied volatility of 32%, a typical move in volatility may be around 1% per day on a normal, non-volatility spike type of day. So it would not be unusual for the implied volatility to drop to 31% or rise to 33% the following day. This is in line with an implied volatility ranging from 16% to 48% annually, which is what we have been assuming for examples so far. But whether we use 0.5% or 2%, it isn't going to change the point here. So let's just go with 1% and keep Vega as is, since it already represents the change in the option's value for a 1% change in volatility. Assuming our 1% daily move in implied volatility, we see that volatility does have a decent impact on the value of an option, especially at the money options with plenty of time left until expiration. But as the option gets closer and closer to expiration, the impact of Vega drops off and other Greeks take over. Finally, let's look at Rho, and we can infer what changes to phi would look like from that. Since Rho is the change in an option's value for a 1% change in interest rates, we're going to have to scale this one down. That is because interest rates in most countries typically change in 25 basis point increments. That's 0.25%. While it is usually the overnight rate which changes by 25 basis points at a time, the impact is typically the same for short-term rates in general, which is likely what would be used for pricing options. So if we divide Rho by 4, we get this. So less than 6 cents, even for deep in the money options with plenty of time left until expiration. And that is if interest rates are cut or hiked by the central bank that day. On a normal day, the change would likely be close to 0. Concerning phi, the magnitude of the impact would be in line with Rho in most circumstances. While there can be large surprise dividends at times, that is very rare, and so we should not account for that in a typical daily move. For most stocks, dividends are adjusted no more than quarterly, and often those adjustments are very small. So the point is that delta, or changes in the price of the underlying, has the largest impact on an option's P&L in typical conditions, followed by Vega or implied volatility for options with plenty of time left until expiration. Theta, or time decay, takes over as the option approaches expiration, and rho and phi have a very negligible impact on the P&L of an options position. So if we could neutralize the impact of price changes in the underlying on the P&L of an options position, then we would be mostly exposed to changes in implied volatility until the option approaches expiration. Let's assume that we want to do just that. How would we go about neutralizing changes in the price of the underlying from affecting the P&L of our options position? What we would need is a measure of how much the value of our option would change for a change in the price of the underlying. Well, isn't that what delta does? Well, let's see. If the option currently has 90 calendar days until expiration, meaning 63 trading days, and the price of the underlying is $100, then our delta would be 0.55. So if we are long one call option, which represents 100 shares of stock, then if we sold short 55 shares of stock, our combined position should be insensitive to the changes in prices of the underlying, right? That way, our combined delta would be 0. Since the delta of the options position is 0.55 times 100, which equals 55, and the delta of our stock position is negative 55, as being long one share of stock has a delta of 1, and so being short 55 shares of stock would have a delta of negative 55. In other words, we would be delta neutral. The best way to answer this question is to try it out. Let's say that the next day is a down day, so the stock drops to $98.30. Our option drops in price from $6.70 to $5.75, giving us a loss of $95, while our short position in 55 shares gives us a gain of $93.50. So our combined position only changed by $1.50 instead of $95. But that raises the question on why our position changed at all when other factors, volatility, interest rates, dividends, were held constant. One thing that we cannot hold constant is time. The other thing that changed is the delta of our option, which is now 0.50. So as the price fell and another day ticked by, our hedge lost its effectiveness. In other words, there is some amount of hedge error. Since our position is no longer appropriately hedged, we need to rebalance our hedge. But how should we go about rebalancing our hedge? Well, we are currently short 55 shares of the underlying, but the delta changed to 0.50. So we would have to buy 5 shares of the underlying so that we are now short only 50 shares to match our delta. If the following day, the underlying continued to fall to $97.86, then our option would change in value from $5.75 to $5.48. That gives us a loss of $27. And our short stock position would show a gain of $22. So we again have a hedge error, but this time it is 22 minus 27, which is negative $5. And our new delta is 0.49. So we would have to buy back a single share to get back to delta neutral. This process would be repeated over and over each day for as long as the trader remains in the position. To speed things up, let's say that the underlying followed this path, which has a realized volatility of 32%, the same as the implied volatility on the call option purchased at the beginning of this example. What would the trades in the underlying look like as the stock followed this path? As we have already seen from the first few days, when the stock falls, the trader would need to purchase shares. Conversely, when the stock rises, the trader would need to sell those shares. We can see that if we color code the ups and downs using green for up days and red for down days, then compare that to whether we would have purchased shares or sold shares at the end of those trading days. And we can see that on days when the underlying fell, we bought shares. and on days when the underlying rose, we sold shares. But did all of this buying and selling of the underlying back and forth accomplish what we intended to accomplish? That is, did it make our overall position insensitive to moves in the underlying? Let's break down the P&L of the position into its components to see. First, we have our option. What was the P&L of that on a daily basis? Those are some pretty big swings, up to nearly $400 in a single day. Let's hope our delta hedging offset those big swings. Let's take a look. It does appear as though there are similarly large swings in the delta hedging leg of our trade. For example, the biggest drop in P&L of the option leg was a down day resulting in a loss of $389 when there were 29 trading days left until expiration. And on the delta hedging leg, we have a gain of $400.20 on that same day, more than covering the loss of the option. Feel free to pause the video and check that other days line up in a similar fashion, or those who subscribe to this channel's Patreon can use the interactive charts to investigate. Another component of our P&L will be the interest and dividends paid or received. Since we are short stock, we will get paid interest on the cash generated by the short sale, but we will have to pay any dividends that the stock would have paid. We will also have to pay interest on the cash borrowed to buy the options contract. And option pricing models assume that all interest paid or received is at the risk-free rate, which we set to 5% for this example. While a lot of the assumptions regarding interest paid or received aren't realistic, these assumptions are meant to account for the cost of money generally, which factors into the no arbitrage arguments used to support option pricing models. Either way, we can see that the amount from interest is hardly worth worrying about. If we put these components of P&L all together, how did we fare overall on a daily basis? Not too bad considering the large swings in our options and delta hedging legs, as our overall daily P&L is in the low tens of dollars. But it is important to note that this is not the cumulative P&L, just the daily ups and downs. If we plot a cumulative P&L, in other words the running total P&L from inception of the trade for each day, we would get this. And we can see it range from close to negative $20 all the way up to nearly $40. But ended at $10.76 on an undiscounted basis. I was careful to include the phrase undiscounted basis because according to the Black-Scholes-Merton framework, the P&L on a delta hedged option when volatility is known should be equal to the risk-free rate. So if we discount the cash flows in and out back to the inception of the trade, then according to Black-Scholes-Merton, our P&L should be $0. But it is not. In fact, it is higher than our undiscounted cash flows. That is because many of the days have cash outflows, and those are having a bigger effect than the fewer large inflow days. Either way, we didn't get $0. That is because Black-Scholes-Merton assumes that delta hedging is done continuously, meaning less than every second, millisecond, or even microsecond, to the point of hedging infinitely, which is not possible in reality. So why does changing from continuous delta hedging to discrete delta hedging give us a different result? I even made sure to use a path that has a 32% realized volatility, and the option we are hedging has a 32% implied volatility. So the deviation doesn't seem to make sense. What could be causing this deviation? To understand that, we have to understand the driver of our P&L in between delta hedges. So when we calculate a delta and then purchase or sell shares according to that delta, what exactly are we doing? One way to think about it is that we are calculating the slope of the line tangent to the option price, as seen here. But the P&L of that line is opposite to the P&L of the option, so that when the option gains, the hedge loses and vice versa. Then when we rebalance our hedge, we recalculate the line given updated inputs, mostly price, then shift that line to the new location given those updated inputs. So what is the change in P&L between the curved option plot and the straight delta hedge plot? Well, wouldn't that be the gamma of the option, as that measures the curvature or convexity of the option with respect to the price of the underlying? It would be. And so gamma is what measures the P&L of our delta hedge from changes in the price of the underlying in between rebalances. One way to think about it is that as the underlying moves higher, our position gets more and more long the underlying as our delta deviates from zero. And so as the underlying keeps moving higher, we accumulate more and more profit as we are becoming more and more long the underlying. So there is a compounding effect. That is what gives our P&L the quadratic shape. We can see that better if we tilt the plot sideways so that the delta hedge line is flat. Now the option curve represents the P&L in between delta hedges, which in this case seems to always represent a gain. This is an important feature of financial instruments that have positive convexity. Both call options and put options exhibit positive convexity. The implications of positive convexity is that as the market moves against you, a position with positive convexity will accumulate losses at a slower and slower rate. In other words, losses decelerate. But if the market goes in your favor, then gains accumulate at a faster and faster pace, so gains accelerate. This deceleration of losses and acceleration of gains means that having positive convexity is beneficial in both directions. So having a position with positive convexity is preferred by market participants, which is why they will pay up for it in the form of an option premium. This bias towards owning positive convexity doesn't just exist in the options markets. It is present wherever there are financial instruments with convex profit and loss profiles, such as in the bond market where it is referred to as the convexity bias. But back to our delta hedged option position. The effect of positive convexity when delta hedging means that as the market moves against our options position, losses on our option position will decelerate. But our delta hedge is linear, so gains on our hedge will continue at the same pace as before, resulting in a gain. But when the market moves in favor of our options position, then gains on our option position will accelerate, while losses on our hedge will continue at pace. So either direction ends up with a net gain when we are long options, and that goes for both calls and puts as both exhibit positive convexity. So if our delta hedging always results in a gain, where does loss come from? Loss comes from the time decay of the option, or in other words, theta. So when we delta hedge a positively convex position, our delta hedging, represented by gamma, always results in a gain, and our losses come from time decay, represented by theta. And this situation is reversed for short options. Let's take a look at a short call option to be sure. As expected, negative convexity. But does that mean that the P&L in between hedge rebalances is always negative? That is certainly what it appears to be, with the twist that theta is now profit. So for option positions with negative convexity, the P&L from rebalancing delta hedges will be a loss, while gains will come from time decay. This table sums up the situation. And remember, long options are always positive convexity, while short options are always negative convexity. And since long volatility trades are typically entered into by going long options, that means that long vol trades will exhibit positive gamma and negative theta, and the reverse for short vol trades. So why does positive convexity play a role in the P&L of a discretely hedged options position deviating from zero? That has to do with the quadratic shape of the options curve when we turn it on its side. Continuous delta hedging, if it were possible, would mean that deltas are rebalanced before the P&L gets far up the quadratically shaped curve, so they don't really take advantage of the quadratic shape. But when we hedge discretely, then the P&L deviates far from the bottom by the time we delta hedge, and so we see drastically increasing P&L in between delta hedges. So it is the convexity or gamma that is responsible for the deviation of discretely hedged options from the theoretical value of 0. And we can see gamma's role in the Black-Scholes-Merton partial differential equation, or PDE. If you have never seen a partial differential equation before, don't be intimidated. We covered partial derivatives in Chapter 3, and a partial differential equation is just an equation with partial derivatives in it. That means that it doesn't tell you something in absolute terms. It just tells you how changes in that something are related. But like many things in math, once you get past the notation and to the concepts, it is pretty easy. This equation uses the term V to represent the value of an option, as this equation works for both calls and puts. Beyond that, we have seen everything here before. The first term is the theta of the option. This will be negative for long options and positive for short options. The next term has gamma in it. While the leading terms are not important for now, so I will just call the whole term the gamma term. This represents the P&L generated from our delta hedging, so will be positive for long options and negative for short options. Next, we have the interest rate multiplied by the stock price multiplied by the delta of the option. This represents the interest on our delta hedge. For a long call option, we delta hedge by shorting stock, which generates cash for which we can earn interest. For a short call option, this one would be negative, as we hedge by buying stock for which we need a loan that we must pay interest on. So the sign of this one will depend on whether call or put in long or short. Finally, we deduct out the interest used to purchase the option if we are long, so we have the interest rate multiplied by the value of the option. If we are short an option, then we would deduct a negative, which is a positive as we earn interest on the option premium. The Black-Scholes-Merton PDE says that all of this equals 0, assuming that continuous delta hedging were possible. Since it is not, we end up with some hedge error as we saw earlier. But the point here is that the inverse relationship between theta and gamma, which shows up when delta hedging an option position. You may have noticed that this equation doesn't include the option Greek Vega. That is because Black-Scholes-Merton assumes that volatility is known and constant, so it doesn't get factored into this equation. But we saw earlier that gamma does play a role with realized volatility when discretely hedging. So gamma is often interpreted as the profit and loss from realized volatility, while Vega is the profit or loss from implied volatility, and both affect the final P&L of a delta hedged option position when volatility is not constant. But since our original reason for entering the trade was because our expectation for volatility was different from the market, what would happen if implied volatility increased? Let's take a look at the effect on our delta hedged call option. Well, the value of our call option would increase, and we could unwind the trade early for a profit. And if our delta hedging was in fact neutralizing the time decay of theta, then we should be break even or close to it before the rise in implied volatility. So we can use delta hedging to trade implied volatility, meaning Vega, but we will also be subject to changes in realized volatility, meaning gamma. We would just have to delta hedge until implied volatility rose to our target level or fell to our exit level, as we should have both in mind before we enter any trade. And those levels would be expressed in terms of volatility. So unlike a directional trade, a volatility trade will typically have a take profit and stop loss expressed in terms of implied volatility, which often requires active management. Our original aim was to find a way to neutralize changes in the price of the underlying so that we could trade the implied volatility of the option. In the process, we have seen that we are also exposed to the actual realized volatility of the underlying. So trading volatility requires assessing both, although they do tend to move in tandem. There is a lot more to learn about delta hedging. In the next video, we will run simulations to quantify how the choice of a delta hedging strategy can impact our final P&L. I would like to give a special thanks to those who support this channel on Patreon. especially for the comments they provided on early versions of this video.